Why are we so quiet? Okay. In that case, let's get started.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Philstock, Wells.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss as you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
There we go. All right, so what's happening today? All right, everybody's good? All right, well, let's take a quick look at the market before we get into questions and whatever. Well, this is funny. Now the Dow is only up 33 points. It was up like 133 points, which means, yep, it was, wow, yeah, it dropped 100 points since before. We called for the short up here at 85. Wow, we nailed that. So we called the short here on the S&P. And by the way, so the reason we called the short here is because the other guys started turning down, and so, you know, if anybody wasn't in it, you take the one that hasn't moved down yet as quickly. And the S&P was the slowest to react to the downside. Wow, these TFs. I wish I still had all those TFs, but I don't. I got out. When I got back to Eden, I got sick of it. But, oh, my God, look at this thing. Remember I had like 20 of these at one point? And I got out of oil. We did oil short at 55, and I got out down here when it hit 54.25. And I'm still short on the gasolines. Basically stopping at 175 if it gets back up. But I'm looking at the gasoline to make a nice move. I'm looking at oil and gasoline to make a nice move down. It's a tight schedule, though, because then there's a holiday. So let's look at the calendar and talk about that a little bit. Wow, still falling on the Russell. Are we finally going to get a correction? It's such a weird time to do it. I like gave up this morning. I'm like, who cares? This can go up forever. That's why you got to play the market both ways. You never know what's going to happen. So here's Thanksgiving. Nope, here's Thanksgiving. Oh, I'll be gone by here. I'm leaving this Wednesday, so it won't be a webinar that week. I'm barely going to get the webinar next week because I'm going to be in the city. Anyway, so here's Thanksgiving. So we don't have long until Thanksgiving. You've got to, right about this Wednesday on the 15th, by then you can't be short on oil. So we've only got about 10 days left to be shorting oil at all. And it's a scary bet because, you know, you can't afford to be wrong, because if you're wrong, then, you can't add to it or double down, because basically it's going to get you don't think it's going to be short anymore. So there's a very tight window over the next, by early next week I expect to be lower, and if we're not, I just got to move along. But I mean, I still have this short. Wow, look at that. Now, so if you want to short something, it would still be the S&P because it's slower than the other guys. The Dow's falling faster, the Russell's falling faster. So, especially if it crosses below this line, which is 2570. So if it falls below the 2570 line, you can use that line for a short and then make it a stop. Oh, wow, did you see silver? Look at silver. Remember we did that long last week from, I forget it was 1680 or 17. But last week we picked silver as a good one, and that's finally taking off. It took a long time. Coffee is still cheap. Here's KCH8. That's still way down here. So that's still good to play at 125. And natural gas, NGV8, is way down at 291, also still good to play. So there's still some things you can play. I wouldn't mess around with the indexes too much. I mean, unless you need the hedge, which we sure don't because we got plenty of hedges. But unless you need the hedge, it's not really worth messing around with the index futures. Now, let's see. Ooh, Wayne had a question. He got his in right away. Is GE a buy here? Yes. Or wait until November 13th analyst meeting to see if the dividend cut or if it's built into the price. If they cut, it'll still go down. First of all, if there are a lot of funds that only can hold only can hold dividend-paying stock. So if GE ceases to be a dividend-paying stock, they have to sell it. So that happens anytime somebody stops paying a dividend. There are a lot of funds that are forced to sell it because they only invest in dividend-paying companies. And it depends on how they announce it. If they announce it's a one-time cut, that doesn't necessarily take them off the list. If they say we're suspending dividends indefinitely, that's the end of it. Then they're no longer considered a dividend-paying company. I mean, certainly not as worried about GE as I am about TiVo, although somebody just rated them. Somebody called them a 17 GE. So that's another 15% down from here. Somebody, I mean, take it for what it's worth. But for me, I mean, it's funny how we have these conversations all the time. I remember having this conversation about Boeing, and I was like, well, it's just stupid. And this is just stupid. I mean, it's a $174 billion company. We had this conversation about Boeing before Boeing rolled out their new plane. Everybody, for whatever reason, was shorting. The old new plane might not be a hit. It's going to be a disaster, blah, 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 blah. And then they got orders and orders and orders and orders. Oh, and they had that battery fire when they were testing the plane. Total insanity. And Boeing went down to some ridiculously low price. I don't think I have a good chart for showing that, but no, none of these. Anyway, so, Boeing was ridiculously low, and I'm like, Boeing. In fact, years ago, GE was down here, around 2009 when GE was in the crapper too. I was thinking, it's freaking GE. I apologize. I'm sorry if I have to say, it's hard for me to get motivated to talk about why GE is a good company. Okay, it's like, why is the sun a source of light in the sky? It should be something. It's a grade school sort of thing. It's like, yes, GE is a good company. They're a giant, diversified, monolithic entity. They have tendrils in all over the world. They're incredibly diversified, and they're a money-making juggernaut. Recently, not so much. But they've been changing their strategy, shedding divisions, and so on and so forth. But here's the company, 117, 123, and those are billions. That's a lot of billions. Okay? And profit, net income, $9 billion, not so good because they did some write-offs, and then $9.5 billion. So they're up around, so they're running $10 billion basically, and you got to pay $174 billion for $10 billion in earnings. So that's a PE of 17. Notwithstanding this, which is trailing 12 months, it takes into account bad quarters. But as they're running now, they're going to make that, and if we look at the analysts, they're going to call for $1 a share, which is a PE closer to 20, the way they're calculating that. So somewhere between 17 and 20 is the PE, which is fair for them. It's not dirt cheap. It's fair. But I don't own a stock like GE because I expect it to go to 25. I own a stock like GE because it's a rock-solid place to put a lot of money. You can't put a lot of money into any old thing. Oh, 85. Look at that. If this green line doesn't hold, they're in trouble. You can't put a ton of money into speculative stocks. Oh, what is this crap? Gee. There it goes. But, GE is not a speculative stock. You can put a lot of, if you have tons of money sitting aside, like we do in our long-term portfolio, it's a nice dividend-paying stock. They pay, I forget, a lot, though. 4.5%, they pay $1 dividend. That's insane. So, here's my thing. So if I want to collect my dollar dividend, I buy the stock for $20. I sell the $20 calls. This is only the 2019, so I don't have 2020 yet. I sell the 2019 calls for $2 and change, so $2.20. So now, first of all, I've already sold 10% of the stock's price. I've got a 10% buffer. The minute I buy it, I get a 10% refund by selling the calls. Then, this is a judgment call, but since I think it's cheap, I would sell these too, and I get another 10% for selling the $20 put. So what have I done? I bought the stock for $20, and I've agreed to double down at 20 minus 2, and minus 2 is minus 4. So I'll agree to double down to 16. So I'm not buying GE at 20. I'm buying GE at 18. That's my worst case scenario. Is I'm buying GE at net 18. But at the moment, I'm going to pick up one round of shares, and it's going to cost me net 16. So if I am called away at 20, I'm going to have a 25% profit on the stock from 16 to 20. I'm going to have a 25% profit, and then I'm going to get $1 in dividend. So that's another, well, off of 16, whatever it is, another 12%. So it's going to be, no, 12%, another 6.5%. So I'll make 30% in 14 months playing GE. Just playing it to be above where it is today in 14 months. And if it's not above where it is today, I'll have to buy more at 20. But my average, because I got $1 in dividend and I got $4 from selling the puts and calls, my average is now $17.50. So when I look at this, I'm not really saying am I willing to buy GE at 20, but am I willing to buy GE at at this bearish analyst target of $17.50? And the answer is, of course I am, because even if they suspend the dividend, I can create my own dividend by selling puts and calls that are going to give me 20% a year returns. So do I want to have a stock? This isn't some bullshit REIT or something like that. This is frickin' GE. And because it's so low in price and volatile enough that the options pay me a good return, 10% on each side, I am very confident that year after year after year, I'll be able to generate a 20% return selling options. So do I want to do that? Do I want to do that with a blue chip stock instead of like some random REIT that might go bust? Of course, you can't have a better play in the market than doing something like this. I could comfortably put 20% of my portfolio into a stock like this and know that I've got 20% of my portfolio is going to generate a 20% return. And by the way, do you realize where's my thing? I'm going to show you this on a calculator, but it's not a new tab. How dare you? Where's my original stuff? Oh, it's over there. What's that then? All right, here. Compound rate calculator. So if I've got $500,000 and I put $100,000 into GE, okay? So 20% of my portfolio I put into this GE stock plan. And now don't forget, I could be assigned. Obviously, with ordinary margin, you've got a lot more buying power. But I could be assigned and I'll have $200,000 worth of GE if it goes badly. But the bottom line is I'm buying $100,000 worth of GE, and I'm going to give it, it's going to make me 20% a year. And let's give it 10 years, just 10 years, okay? So in 10 years, just this side money that I'm putting into GE, 20% of my portfolio goes into this one stock, and it's going to return over 10 years $619,000. That's in just 10 years. Meanwhile, I got $400,000 for the rest of my portfolio to do other stuff with. So you want to have a stock, and I don't mean one stock, but I'm saying, technically. You want to have one stock or one set of stocks where you put a chunk of your portfolio that's going to generate you a very, very solid, very reliable return. Now, I don't give a crap about this. That's not the point, because if you take $100,000 off of this, I'm going to make the money regardless of the price of the stock. Unless it goes drastically down, then I'll make a lesser amount each year. But assuming it's around this price, around 20, 15 to 25, anywhere from 15 to 25, I'm going to make this money. I'm going to make $500,000 and $519,000 more dollars over the course of just 10 years. Okay. Now, obviously, this means you're putting money back into the stock and so on and so forth. So when you make the money, you put the money back into GE, you keep buying it, and it compounds. Otherwise, you're not compounding. But I just want you to understand how powerful that is, because you're basically assuring that no matter how screwed up you make your other $400,000, you've got one thing that's going to guarantee that you keep the money you started with, and it increases in value. I'm talking about the $500,000 you start with. That you won't. That 10 years from now, you'll still have $500,000. So if you're like doing a college fund, like my kid's money, if you're doing something like that with the college fund or with something or your retirement money, at least you know that if you put $500,000 away now and you place some part of it, and I'm talking about part of it conservatively, you'll have that. Now, should you do that? Yeah. What if you put $200,000 into GE? Well, it's going to be $1.2 million. It's not complicated. I mean, you can play with these numbers on these calculators. You put 200 in, it's going to be, gotta hit that little button. It's going to be $1.2 million. So, and if you put the whole, by the way, if you put the whole $500,000 into conservative things like this, you'll have $3 million in 10 years. And again, why do I like the GE play? Because I know for a fact there will always be options. And as long as they don't go bankrupt, there are always options to play. And we'll talk about FTR next, where you're looking at companies practically going bankrupt, but you still make money. So it's a very interesting game you can play with these things. Teva might go bankrupt. It's not the same thing. I wouldn't take 10% of my portfolio and put it into Teva, because they could go bankrupt. And yeah, GE could go bankrupt, but it's like you can't even get your head around how it could happen. Teva, they have a lot of debt. They might go bankrupt. GE's got a lot of cash. They've got like $85 billion in cash overseas. That's like half the value of their company. Here, wait. GE overseas cash. Don't you love Google? They're not being specific. What is that? Oh, here you go. GE. No, they're not telling me. Oh, here you go. 13 companies with most cash overseas. GE. Number 13. Oh, $35 billion. Sorry, $35 billion overseas. Still, it's a nice amount of cash. It's a lot less than I heard. Maybe they did some of it back. Oh, GE's retrieval of overseas cash. Oh, that's why they already took some back. It's half. Okay. So they already pulled half their cash back. But anyway, it's a giant company. They've got tons of cash. They make tons. They make $9 billion a year. Come on. They're not going bankrupt. You don't go bankrupt when you're making $9 billion a year. And if they're not going bankrupt, then I know I'm going to make my money. If I know I'm going to make my money, why wouldn't I buy them? Investing is not as hard as everybody makes it out to be, okay? Everybody makes it seem complicated. It's not. And buying a stock, if you're a real estate person, you would get this. Because, look, when you buy a house as an investment, you buy the house. You don't expect to make money on the house. You don't buy the house saying, people do, but to be a real house, to be a real home investor, You don't look to make the money on the appreciation of the house. That's what flippers do. That's speculators. If you're an investor, you look to make your money from the rents. And believe me, the richest people in the world in real estate are not the people who flip houses. They're the people who buy property and rent it out for decades, and then they buy more property and rent it out and buy more property and rent it out, and they end up with this tremendous cash flow that they leverage into more properties that they rent out. Okay, even Donald Trump, the great real estate guy, he doesn't flip things. He buys something and holds it and gets tenants. That's how you make your money. That's how you make your sure money, and that's the difference. You might make money, you might lose money if you're speculating, but when you're renting, it's almost a mathematical fact that you're going to make your money, unless something goes very wrong, and most likely it's because you've misread the market somehow. It's very rare you can't fill a place and rent it out. So if you buy it for a reasonable price compared to the rent, you'll do well. That's what we're doing. We're buying a place. We're buying a stock, and then we're renting out the position and collecting interest. That's how it works. Selling the options is no different than collecting a rent. We're collecting a rent on our position. This guy is renting it, is renting out stock in hopes it goes up, and this other guy is renting it in hopes it goes down. I don't give a crap. Whether it goes up or down, I get my rent money. If it goes up too much, it'll get called away. If it goes down too much, I'll buy more cheaper. I want to buy more cheaper. Remember I said you've got to reinvest your dividends? Well, what better to reinvest in than more GE if it goes to 15? And then if it goes to 10, I'll buy more GE at 10. And I'll keep selling and getting my 20% back. As long as the stock's still going to pay me my 20%, I don't care how much I have to buy. That's what I want to get across to you guys, and that's especially with things like TIVA or FTR. So now let's look at TIVA. I'll show you that one. So TIVA, first of all, just so everybody's on the same page. TIVA down and down and down and down. And I think we started coming in around here when it hit 30. And then it had that horrible drop. We thought it would hold up. We added some, and now we're kind of, this is where we are now. I forget what our position is. Where's our thing? At the moment, we have 30, 17, 50 calls. Now we're going to have to adjust this because it's down severely, and there's no sense in holding on at this level. Now we're not buying the stock, but we have the calls. But conceptually, we'll add to the position. And we're in this one we're in it to net 18. No, I'm sorry. It's a net credit. We have a huge credit, but of course we have a loss also. So we have a credit of $18,000, and currently we're negative. So we start out with an $18,000 credit. We currently have a $30,000 loss. So we're net negative $12,000, which is what these kind of add up to. So we're minus $12,000 basically on this position. We have to decide what we want to do. So we look at TIVA and we say, well, gee, do they pay a dividend? Is it worth owning the stock now that it's so cheap? So we have to think about that too. We already have the put, so we'll be assigned the stock if we don't do anything else. They pay a nice dividend of $1. We like that. Okay, so if they keep paying that dividend, and we'll wait for earnings and find out what happens. Will they still pay that dollar? Because they have a lot of debt. That worries me. So probably I'm not going to jump right in and buy it. But so let's assume we want to continue where we are. But the thing that even so, though, the point is I can collect TEVA. So we've got the 1750 calls, and they're about 92. So that's 440 days away. So 40 days away, 10% of the time away. What can I do with them? I can sell, TIVA's at 13. I can sell the $15 calls. It's lower. I understand it's lower, but I'm just saying I can sell the $15 calls for 65 cents or 67 cents. Well, 10 times 67, because it's 1/10 of how many times I get to sell. 10 times 67 is 670. That's a freaking lot more than $1.92 or $1.80 or $1.80. So this 180 position will allow me to sell these for 670, but I don't want to be in a 180 position because what if Teva suddenly blasts higher? What if somebody buys them? That's my biggest fear making a play like that. What if somebody buys Teva at a much higher price than I got it? Then I'll be 250 upside down. So I got to worry about that. I could be 250 upside down, but you know what? I have the short puts. So let's go back to it again. So I have to think about this, and maybe it will work. I've got these short puts, the January 25s. I have 30 of them, and they're deeply in the money. So I effectively have a huge upside cushion because I'm not going to cry if I have to give back money to the short caller, but then my short puts expire worthless, and that's good for me. I don't care about that. So I really shouldn't even worry about the gap that I have here. So maybe that's a good way to get out of this position because we can collect. What did we just say? $6 basically from selling calls every 40 days we're going to sell calls basically, and we're going to collect $6, and then $6 times, not 60. So $6 times 3,000 is $18,000. So even though I have a $12,000 loss now, just by selling those short calls, I can collect $18,000. Now that's selling the $15 calls with Teva at $13.86. So in other words, what I would do is every time Teva gets if it gets a little bit higher, I'll sell next time. I'll sell the let's say March would be the next one I sell. No, it wouldn't. January would be the next one I sell. So January we sell the 15s and 99 there. So I could actually sell the 1750s. So if I had to roll, I would roll to the 1750s. Once I'm in the 1750s, I'm covered, so it wouldn't matter. But I could start by selling these 15s, collect 67 cents on the 15s, and already, again, am I going to make 20% on the position? That's one of the ways I decide if I like a position. Do I think the stock won't go bankrupt? If it won't go bankrupt, then there's only really one thing I got to worry about: how much can I get paid for owning it? And in this case, I get paid 67 cents in 40 days, and I own it for 448 days. So it's actually 11 payments of 67 cents I have to look forward to. So that's still a good stock. Now, if I actually own the stock for $13, well, if you own it for $13, you can't possibly be harmed by selling the calls, right? So if I own it for $13 and I sell calls for $6 over the course of the year, I'm getting almost 50% of my money back just from that. And then I'm going to get $1 in dividends. So I'm going to get like 60% of my money back in call sales and dividends, and I got no risk at all on a straight purchase. So I like that. And now I have to say, well, do I think will they go bankrupt this year? So as long as they will bankrupt this year, I'm going to collect half my money back. It's a pretty good bet. So as a straight up play, I think what I would rather do, if I was going to do this from scratch, I would probably want to do the spread, though. I'd want to go with the 15s are so cheap. Well, no, because it's at 13, isn't it? The 1250s are $3.75, and then you can sell the 20s. So you go from the 1250s are $3.75. The 20s are $1.30. So $3.75 minus $1.30 is what? $1.45. So for $1.45. I'm in the spread. Now, it's a $12.50 spread, so effectively I paid $13.95 for the stock. The stock's at $13.87. So for just $1.04, so for really for just $1.45 cash out of my pocket, no margin at all, I can have this spread. Then I can sell some short calls. Now I've got I'm in for $1.45. I've got I've got $7.50 total, so I've got another $6 of headroom that Teva can go up on me. So I can look at it two ways. I can either do it to make money, I can do it for a profit, and if I want to do it for a profit, what I would do is sell the $15 calls, because don't get the $15 calls at 10% out of the money. But I wouldn't sell 100%. I would sell like probably a half a cover or 2/3 cover, just in case it does pop up on me. I want to only get 2 burned. Or I could play it safer and sell the 1750 calls because they pay 20 cents. And 20 cents times 11 payments is 220. So I'm going to get 220 back on my $1.45 investment, even if TIVA does nothing. Nothing. If TIVA just does nothing all year, if the spread expires worthless, I'm still going to make a 50% profit because I kept selling the calls all year. As long as I get 20 cents per every 40 days, and now obviously that's not hard to do because I'm selling 1750s, which are $4 out of the money for 20 cents. And this is in a crappy low VIX environment. So there's many ways. I haven't even sold a put or done anything. That was a no margin play on the back end. Here you'll have a little bit of margin on the short calls, but not that much. And it's not that bad because and especially if you have a portfolio margin account, they take into account that you have the coverage up to $20. So that's what I mean when I say, do you not worry about it or do you want to have a stock? It's like my wanting to own a stock isn't always based on whether or not I love the stock. I could care less whether TIVA goes up, down, or sideways. If I can make 50% a year selling calls against a long position, which is what we do in the butterfly portfolio, by the way, that's pretty much essentially all we do in the butterfly portfolio. If I can do that, I don't need to do anything else. In fact, frankly, the way TIVA looks here, I think I want to put it in the butterfly portfolio. It's a little bit of a wild stock, but the returns are compelling. It's exciting when you can make that kind of money selling puts and calls. I'm not taking the risk. I'm just spending $1.45 on the long position. You're taking the risk. The guy who's paying me 20 cents to bet that they're going to be over 1750 in 40 days, that guy's taking a hell of a risk. And if it is over 1750 in 40 days, then my spread is $5 in the money before I owe him a penny. I mean, it's crazy. Can you get burned? Yeah, sure. If they get bought out for 30, I'm screwed. So if they get bought out for 30, I have to pay this guy $12.50, which is more money than my longs are going to pay me. So my longs are only going to pay me $6, and I'd owe him $12.50. So I have the possibility, if TIVA gets bought out for 100% more than it is now, and I have no way to adjust or anything like that, that's where it is. But then that's why I like to sell puts too. So I'm like, well, I sold the put, I can't get too burned. If I sold the 1750 put for $5, there's almost no way it's going to burn me to the upside. But then, of course, if it goes lower, I can get burned to the downside. But if my downside risk is owning more TIVA at a net price of 1750 minus 5 is 1250. If my net risk is to own TIVA at 1250, I might be like, why not? Okay. But again, all this on TIVA after earnings. I really would want to see what they say for earnings before I go into it. On the other hand, though we saw just FTR just had earnings and they sounded fine and the stock completely tanked. It's a disaster today. Where are they? And I like FTR. I try to figure out why everybody hates it so much. Oh, not even $9, $8.88. They are being sold as if they're going bankrupt today, and there's nothing in their report that indicates that. They had an upbeat, strong report, great numbers, making progress on the merger, on the acquisition that they did from Verizon stuff. It's just crazy. But what are you going to do? You gotta just wait for it to be done, let it play out, and then see what you want to pick up at the end. So yeah, FTR is pure panic. I've seen no news. If anyone sees any news that tells you why it's going down like this, tell me. But I don't see it. It's really crazy. We already do own this stock, and we will be doubling down on it. At this price, you have to double down. You don't have to, but at this price, why wouldn't I? FTR. Here they are. We We have 4,000 shares at $19. We sold 40 puts, so we obligated to buy another 4,000 shares at. We sold the $10 puts for $5, so we're obligated to buy 4,000 more for $5. Now they're at 8. So honestly, they're actually still higher than where we promised to buy more. But at this point, though, if they're still paying their dividend, they just said they were. If they're still paying their dividend, which is $2.40 against an $8 share of stock, the dividend is 25% of the stock price. That's crazy. So I might be inclined to just go for more. And if we go for more, we were just talking about this in the chat room. If we go for more, if we double down here at $8 or at $9, let's say, that's going to be $29. So our net average is $14.50. All right, so we have 8,000 shares at $14.50 average, and they do have 2020s, right? So, and we could sell the 2020 $10 calls for $1.35. I'm not saying I want to do that. I'm not too keen on that. But if we did sell the $10 calls for $1.35, that would bring our average from 14 down to like 12. So we'd be basically in the money. And don't forget we sold the puts. So with the put sale, we're actually it brings our whole average down to right about $10 or lower. And we could sell more puts, so we could do a lot of things. But at the moment, we can drop our average down to $10 from 19 very quickly if we want to. And I'm not sure I want to do that. I don't know. You got to give it a few days and see what the hell is going on. But at this price, if they're still paying a dividend, it's like crazy not to own it. It's just an automatic payment of 60 cents. It's almost 10% a quarter coming back to you. So from scratch, I totally love these guys. I mean, from scratch, there's no harm. Because if you buy the stock for $8.80, say 9. You buy it for 9. You sell the $8 puts, the $8 calls, lower than your strike. You sell the calls for $1.70. So that drops you from 9. Well, it's $8.90. So let's say it drops you down to 7, basically. So your net becomes 7, and you called away at 8. But then you could sell the $5 puts. That price cannot be right. Well, the $195 and $350, let's call it $250. So you can sell the $5 puts for $250, and now you've knocked your basis down because you sold the other guys for what, $170. So now it's $250, $320, $420. So now you sold $420. You've knocked off the price. So you bought this thing for half price already. So your net is $420, and you're going to get called away at 10. And you own the stock, and they're going to pay you a $2.40 dividend. So your net's going to be like $2 at the end of the year. So unless they go below $2.40, you're going to make money on this stock. And if they don't go bankrupt and they do go up, you might get called away above 10 with a triple, or you might keep the stock. If it's less than 10, you'll still have the stock. You can sell calls and puts again, or you can just keep it and collect the dividends of it. And if it's $2.40 stock paying you a $2.40 dividend every year, you're getting 100% of your investment back every single year. Again, when you have a $500,000 portfolio, if you can put just $20,000 into something like this, which is 4% of your portfolio, and you're going to get a $20,000 bonus every single year as a dividend payment, that's 4% of your entire portfolio every year forever as additional gains. And if you lose it, you take a 4% loss, or maybe you lose half, maybe it's a 2% loss. So is the risk versus the reward worth it? Of course it is. It is just stupidly. I mean, maybe they're going to go bankrupt, and everybody's going to go, see, they went bankrupt. That's what happened. But they're being priced like they're going bankrupt. Being priced like you're going bankrupt doesn't mean you're going bankrupt. Don't forget, pretty much every single company in the market was priced as if it was going bankrupt in 2009. And that didn't happen. And now they're at all-time highs. So if it can happen to every single stock in the market, it can certainly happen to one stock. What's my take on coffee? I like coffee. Look, our long play on coffee is based on the fact that global warming is damaging to coffee crops. Only grows. Coffee grows on a mountain between, depending on the type of coffee and what mountain and whatever. But for example, it grows on a mountain between 500 feet and 1,200 feet that you can grow the coffee, but above that, no, and below that, no. That's how sensitive coffee plants are to temperature, climate, moisture, etc. So when you have drastic changes in climate, you completely wipe out coffee crops on a very large scale. They haven't been hit that hard. But also, sometimes you get lucky and it goes the other way, and you have incredibly great crops where you don't usually have them because the climate happened to turn favorable in a certain region. So there's a randomness to the thing, okay? But we're betting on the randomness going the other way. That at a certain point in the next couple of years, there will be a drought that hits that band of where they grow coffee, which is kind of like equatorial. So along the not at the equator, but whatever those meridians are above and below it. So at those bands where prime coffee is grown, we expect that there will be there'll be a change in climate that causes damage, and that there'll be a one-time shortage. So we're just kind of want to be there when it happens, so we keep going along on coffee. There's no major thing. It's not like natural gas. Like natural gas, we're exporting natural gas, and it's ramping up at a considerable pace into next year. So we know next year we very, very much expect there to be a tremendous amount of export of natural gas, and that's going to change the dynamics of the natural gas market. So that one is a different premise because that's something where it's a mechanical sort of thing. The coffee premise is based on climate change, which is, iffy. Not that the climate isn't changing, but just, from year to year, you can't tell which way it's going to go. So we'll see. But that's what I think about Joe. So I like Joe. I want to be in it. It's the kind of thing I like to have something in. We play coffee long, not Joe, but you can play Joe also. I would always make sure I collect some money selling puts and calls because it decays a bit over time. The ETFs, you hold on to it. Are you still long NGF8? I was never long NGF8. It's what is it? V8, right? I don't know my thing. V8. We're in NGV8 on natural gas. And that one is currently 291. And I've got about 4 long. With regard to letting go of oil shorts, is that for the SCO spreads we just wrote? No, those we can hang on to. Those are to April. So that's by April for sure, I think the thing will collapse. We might look at it. It might collapse in December too, but, it does sometimes. But by April, what's the catalyst between, in January, February, March, what is the catalyst for oil to go up? It's the slowest time of year, low demand, less driving. If you have a few storms, people get shut in, demand drops like a rock. There's no particularly good reason the oil should be higher into that. So I like the SCO spread. That one I'd actually put more money into and push it, but we just did. But that's because it's April. I'm not as worried. What's your thought on Qualcomm? We talked about that during chat as well. Again, very bad. It's not a spat. This is a breakup, and I think they broke up. It was a bad idea, okay? Because the other phone companies are not. I think Apple's going to pretty much, like they did with the iPod, I think they'll end up eventually wiping out pretty much every other phone maker. Like with the iPod, who else do you get an MP3 player from? Not that anybody even gets an iPod anymore because everybody's got a phone. But conceptually, when you saw what happened with the iPod, like one by one, no matter who came out with what, Apple eventually wiped out every other competitor. And I think the watch, because the watch is now a phone, you don't need a separate phone now, the watch is now cellular. So I think the watch is now a low-cost phone, and the iPhone SE, which was the old 5 with Siri, is now $350. And at the rate these things are dropping, that means basically the iPhone 6 will be $200 in 2 years. And that means free. I mean, and not only free, but you know who's going to start giving away? Apple's going to start giving away when you sign up for like a 3-year iTunes account. They'll give you the phone. What's going to happen to everybody then? And this Apple Pay starts catching on, and everybody's swiping and shopping and using it for this. It'll be like instead of a wallet, you're going to have to walk around with you're going to have either a watch or a phone, and that's your wallet. But because of the watch, don't forget, you don't even need to carry around a full watch. You can have a little, you can have a watch, you can have a little pendant thing. You can just have a thing in your pocket, like a car key. Like, you have a car key in your pocket. Instead, you're going to have this little Apple thing, if you don't want to wear a watch, I'm saying. But you have a little Apple thing in your pocket that does everything. And when you want to look at the screen, you pick it up and look at the screen. When you want to talk to someone, you pick it up and talk to them. But the rest of the time, you just be in your pocket, like a car key, something you don't even think about. And not only that, it can probably start your car too. So you won't need a wallet, you won't need a phone, you won't need anything, just this little square thing that goes in your pocket the size of their watch face. I mean, it's crazy. And that's the future. It's coming fast. It's coming very fast. It's already it's weird. Like, if you think about it, some people are moving towards, like, you can use your phone for your ID, and there are states that are talking about, like, your license will be on your phone. So if my license is on my phone, and if my credit cards are reliably on my phone, I mean, they're reliable, but, there's something, well, obviously you go to, like, a lot of places you go to don't take the Apple Pay, like wave your phone at the restaurant or something like that. But once that starts up, what am I going to bring a wallet for? You won't need it. All your stuff's going to be in your phone. The Apple thing in your pocket can't be square outside round as well. Okay, whatever it is. I mean, whatever makes people happy. Well, you can make it all kinds of shapes, right? I mean, these days with the way they make screens, it can be all kinds of shapes. It can be a thing that unfolds into like a big screen if you want it to. There's all kinds of weird stuff they can do these days. So anyway, Qualcomm is not working with Apple is going to be a very bad thing for Qualcomm. And it's not good, and I wouldn't jump in on much as we like them. We have Qualcomm. We sold... what do we have? We have the 40-55 spread. So they're at 52 now. I'm not going to get out of it, but that's where we were. I mean, our target was modest. It was 55. So we were never thinking they deserved to be much higher than that. So basically, they're just back on target as far as we're concerned. It's not something I think has a big upside. Now, meanwhile, the spread is pretty good. We paid net $4,000 for the spread, and it's a $15,000 spread. Now it's up a bit. It's up about $2,500, but it was a good spread, and we're happy with it. So I'm not going to jump out of Qualcomm, but I think long term, not working with Apple is going to hurt them. They can't just make up that business. Math is wrong on Tiva bull spread. It's 245, not 145. It is? Okay, I'll take your word for it. All right, well, in that case, your return is less. But it's still a nice return. Let's say it that way. It's not amazing, but it's a nice return. You're going to basically get you're going to get, I think, 90% of your money back based on that math. FTR, the only thing I've seen is how they lowered guidance, but I don't see how much. Yeah, I mean, unless they're lowering guidance to a loss, I'm not really inclined to get out. They lowered free cash flow for Q4 by $100 million. Really? And how much? How much is the number they're giving? Because again, if it's not negative, what do we care? Oh, the Fed. Hey, yeah, thanks. Forgot about that. That'd be interesting to watch. So what's the long-term price outlook for natural gas? I said for a very long time I expect natural gas prices to go back to like $4.50, and probably by the end of 2018 into 2019 I expect to see $4.50. And I think that's essentially where we're going to level out once they've got a lot of exports going. U.S. natural gas exports. Here you go. So this is what's happening now. This is where we are. Here's 216, right? We're right here, like barely moved. I hope you guys can see it. But we barely moved. These things are coming online. See 2020? That's gigantic. That's going from exporting 2 to exporting 6 in 4 years. So in 2018, we'll be here. And by 2020, forget it. Then obviously the amount of exports is going to be gigantic. So that's what's going on. It's all about this. The LNG exports is the thing that's driving the market. But they're very, very slowly building these terminals. Once the terminals come online, they're going to grind out and send out tons and tons of natural gas. So it's a now thing. It's happening now, and they're on schedule. Things are looking good, and it's going to ramp up really hard and fast over the next 2 years. So that to me is like, it's just a fundamental investment. It's just like, yeah, well, obviously it's going to go up. Just like gasoline right now was going up because, we're exporting much more of it. That's what the main reason it's going up. It's not a demand thing. We're just exporting it. So it makes it look like there's demand, but there's not. Oh, yeah, tiny pocket on my leaf. I'm just thinking of getting a watch and wearing it for a pen. I don't like wearing a thing on my wrist. It annoys me. But I was thinking about actually getting a watch and taking a band off and just having a little pendant like I have. So that's nice if you don't feel like carrying your phone around. Something I can shove in a bag or whatever at the beach. Because it's like a beeper basically. It's like if there's an emergency, I want to know what's going on. If my kids need me, I want to be able to talk to them and respond. Well, other than that, though, I don't need to carry my phone everywhere. That's not necessary. All right, said. Yeah, it's been an hour already we've been doing this. Flying by. Said. Okay, so any minute now, we're going to get the reaction. Let's get Mr. Wall Street Journal so we can see what they have to say about it. GOP tax plan, well, this is such bullshit. Won't cut the rate for the highest earners. Yeah, but anybody who earns in the 39% bracket has an accountant who's going to set them up with a corporation. And they're cutting the corporate tax to 20%. So they are going to cut it in half for, you got to be in a really weird situation not to be able to get your taxes cut when you're in that bracket. Yep, GOP goes with the global flow to tax people, not companies. Okay, Fed to stand pat could hint at a rate hike. Bank of England sets a stage for a rate increase. Well, no. GE shows how black box assets boost. GE listed the on accounting analysis. It was said to be true of page spotlight changing among group listed assets. Okay. New York Times is making money amazingly. All right, how are we doing for time? It is 58. All right, we'll see what happens with the Fed here. Questions. And what are the markets doing at the moment? Let's see. Hope springs eternal. If I was going to go long, I'd go long on the Russell right now. They've been the bounciest. Ooh, oil below 54. Gasoline, 173. Oh, fantastic. That's my break-even point right there. I'm so happy. Okay. RB. Oh, it's not X7. The old one. RB. Oh, no, there it is. Still down. $1,100. I need I need 173. That's one. Still, that's very good. Nice improvement from before, let me tell you. All right. Good, good, good. TV so I can do the expert analyst. Here it is. Unchanged. It upgraded the economy. They're maintaining the target for the funds to 1 and 1 1/4. The stance of monetary policy remains a common supporting some further strengthening labor market conditions, sustaining return to 2%. So it's a nothing report. It does basically indicate that they're still going to tighten and that everything is moving the way they thought it would. I mean, they're saying nothing here, really. Gasoline prices rose in the aftermath of the hurricane, boosting overall inflation. However, inflation items other than food and energy remain soft on a 12-month basis. Both inflation measures have declined this year and are running below 2%. Market-based inflation measures. I mean, does it occur to them that what they're doing doesn't do anything to help inflation? Otherwise, it would have worked by now. Just maybe, that's something they might want to think about. Anyhow, so that's that for the Fed. Getting a little bit of a boost in the market, but not much. Oh, wait. I'm going to get out of my gasoline at this point because it's not worth it staying in it since it came back so much. It's a shame. I really want to stay in longer. Yeah, I'm begrudgingly going to get out. Yep. I don't like the way it's looking. One. Whoa. Here. Two. Sucker on the line there. Raising the price. Oh, wow, that filled and I wasn't even at it. Last one. Come on, give him a credit. Ooh, it shot up. Look at that. I'm glad I got out. That 14 cents, I mean. All right, so $2,000 loss. But fortunately, I made that up totally with silver. The silver was a nice $6,500 gain. So, saved my ass there. All right, so this one didn't work out, but silver did work out, so we're all good. Obviously, I might want to go in again if we get a really big pop, but it's not that interesting. Now, let's see about the indexes. How are they doing? Because maybe we can grab this guy if he goes over 490. So, yeah, if you're going to play on the index. Oh, no, that was a mistake. I was trying to roll my mouse wheel. It didn't work. If you're going to play the indexes, you wait, was my point, until it gets over the 490 line, because then you can use that for a stop. See, this is not a good entry. So you only want, so I'm flat now, right? Yeah. All right. So I only want to enter at the 1490 line if it's going over, and then that becomes the line I stop out at. Because it's probably not going to go blasting through it. It's going to stop. If it doesn't get rejected, it got rejected. If it doesn't get rejected, then it's probably going to be a good line it'll pause at before it goes any lower. And that's the key. It's having a good place where you can definitely stop out, where you say, okay, well, it failed this line, now I'm going to get out. But you don't buy it on the way up like I accidentally did. You buy it as it's crossing or right after it crosses, because you want to use that line, that 1490 line, to look for your stop. So right now it's being upside resistant. Now, not any strong feelings. The Fed statement said nothing really. I mean, it's very. I mean, really. I mean, literally nothing. It says labor market continue to strengthen, which is weird for them to say. Considering now, see, I consider this bearish because the labor market. We had a terrible jobs report in the last report, so they must think that we're having a very good jobs report in the next report. They probably have at least 250,000 jobs in the next report, because they're just ignoring the fact that we only had 100,000 jobs in the previous report. They're blaming the hurricane, so the drop in payroll in September, unemployment declined further, household spending has been expanding moderate, business fixed investment picked up, gasoline prices rose, blah, 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 on the hurricane. Consistent with the mandate, the Fed seeks to boost, foster maximum employment and price stability. Hurricane-related disruptions in building will continue to affect economic activity and inflation in the near term, but past experience suggests some storms are unlikely to affect the course of the economy over the medium term. The committee continues to expect with gradual adjustments, the monetary will expand. Inflation on 12-month basis is expected to remain somewhat below the 2% level in the near term, but stabilize at 2% over the medium term. The medium term means more than 12 months for them. So basically, into next year, we're barely going to see 2% inflation. Near-term risks are balanced. Labor market, this says so little. Labor market conditions stable. The target rate is 1 to 1.4. Now, we're only at 0.5. So they're talking about at least doubling rates in the next 12 months. At least double. So double to 150% increase in rates. Monetary policy is accommodative, supporting, they consider that still accommodative. They're saying so little here because they don't know who the next chairman's going to be. And they don't want to lock anybody into anything. So they're being super vague and super, minimalist in their statement. So there's nothing here. And any reaction you're seeing is just, people just doing what they were going to do anyway. So it'll be interesting to see if we do fail to hold these points. So the dollar is nothing. See, you got no reaction from the dollar. You got oil. Here's the Nikkei. Ooh, too bad. Coffee's moving up though. I don't know why. Coffee's moving up. Natural gas is basically not even trading. Silver, big pop, but that was earlier. It's not retracing it though, it's staying up there. So I think the dollar is probably likely to weaken. The 94.50 now, and they're still being very accommodating. So I don't see anything there. And the indexes are not really making much of a move. They're bouncing a little bit. But don't forget that we calculated bounce. We fell from 15, well, we ignore this a little bit up. We fall from 15 to 85, and that's a 30-point drop. That means you get a 6-point drop. So 91 is a weak bounce. And if they're failing the weak bounce, that's not a good sign. And everybody here is basically failing their weak bounce right now. So this is actually a bearish sign for the indexes at the moment. There's nothing bullish about what's going on here. If there was going to be a big positive reaction to the Fed, we'd at least see the weak bounces get taken out. And that's not happening. So I don't think much of this rally. Oh, I'm glad I got out of that one. Look at this. And now we'll see how high it goes. Now, I'd love to see this one get back to 175 and short again. That's gasoline. That was kind of boring for a Fed decision. So what's the long-term outlook for natural gas rate? the Apple thing in your, oh, that's it. No, nobody's got any comments? All right, good. Then I can do what I want. I don't really have a plan. I thought the Fed would be a longer discussion. So let's take a quick look at some of the portfolios, see how we're doing. This is the long-term portfolio. 166, that's 232%. Things down a little bit. Oh, where are we? I think we were 167 actually. Hang on a second. Portfolios, portfolio review. Oh, because CMG killed us, I bet. Yeah, Chipotle. 1677. Ooh, 1677. We got $17,000 since 10/20, so in 10 days. That's not good. How's the short-term portfolio holding up? Was 330. Short-term portfolio. Hopefully not too much damage. Hey, 334. Okay, so he's up 4 or 5, and the long-term's down. So basically, we're kind of flat, which is what we want it to be. We locked in our positions. We want it to be as flat as possible. Oh, we did pick up cash in the long-term portfolio. How much cash did we add? Because we cashed in a few of the long positions. So the short-term portfolio is where we have all our hedges. 1336, and we were at yeah. So we added 200,000. We moved 200,000 to cash. That's also nice. So although we did lose a little bit of money in the total value of the portfolio, we moved more to cash, which is safer, and by its nature, we now have less at risk in the market, and therefore the hedges in the short-term portfolio become stronger because they're the same hedges with the same amount of money if the market goes down, but now they're protecting a much smaller amount of positions. So that's the key to that. And then we've got the options opportunity portfolio. $237 because they don't have CMG. Chipotle really killed it. Where is the OOP? Here it is. So it was 332, and now it's 337. So up 5. That's about right for 10. After 10 days, it's right on track. And there's your 5%. That's why it's called the 5% portfolio, though. It's meant the purpose of it is to make 5% a month off the original $100,000. So we already because we're up 200%, we now make more like $10,000 a month on the average month. But in this portfolio, we don't have any crazy. We don't have Chipotle, do we? We should add Chipotle, though. We don't have Chipotle, but I'm tempted to add it. But the problem is it's such an expensive stock, it's tricky to deal with. So we'll see what happens. So this is a nice, well-balanced portfolio. I'm very, very happy with our positions in this one. Ford just took a hit, but now you see Ford, we play conservative, though. It's that thing where we're talking about. We bought the stock for $11.26, but we sold the $10 calls. Because we only bought it for the dividend. We didn't buy it to make money on the stock. We bought it to collect dividends. That was exactly the example I wanted to show. The reason we bought Ford was to show this example of why we do this and how it works. Right, did we do GM also? No, we didn't. But that was exactly why we bought Ford that way. We bought Ford when it was higher than the price we wanted to sell it for. We plan on selling Ford for $1.26 less, for 10% less than we bought it for. That's our trade. Because we're mostly in it for the dividend, but we also sold the puts because we were like, well, if it is below 10, we'll still buy it. So then we sold those for 90. So we collected 185 plus 90 is 275. So basically 850 is the net cost of Ford. So if it gets called away with the $1.50 profit, that's like a 20% profit plus the dividend. And that's it. Easy peasy. We don't care if Ford goes up or down. It doesn't matter to us, okay? We got it cheap. We collect our dividends. We collect the money we make for selling the puts and calls, and that's our play. And yeah, generally the options opportunity portfolio tends to be a little more aggressive than that, but we've got plenty of aggressive positions, and we also have plenty of cash sitting at the sideline. We've got $146,000 in cash not doing anything. So got to do something with our cash, so we take positions like this. That's going to bring us back a couple of $1,000. That's 1% back on the portfolio. So of all the cash that's sitting around, we're going to pick up like 2% on the cash on hand. So with just that one little tiny position, I'm making enough interest that there's no reason to put the rest in the bank. I can just leave it here. That's how you put the margin to work for you when you're not using it. When would you cover LB and would you play it like your TV example? No, because they don't pay a dividend. And LB, I hope we don't have it anymore. Do we? Oh, no, LB. I'm thinking of Lumber Liquidators. Sorry, LB. When would I cover LB at 45? We missed it. I think we missed it. We should have covered it already. I already made that comment last time. Wait. We got aggressive and we'll see how earnings look. Oh, we were going to wait for earnings. But a move to 45 would get me to cover. I didn't mean after earnings. I meant anytime it moves to 45. And it did. Look what happened. We should have covered. So, yeah, you don't look a gift horse in the mouth at 45. We should have covered. So we still should be probably covered. Now that we missed it, I'm kind of watching 42.50. And if it goes below 42.50, then we got to cover. So would you cover LB and would you play it like your Teeber example earlier? Yeah, I mean, if you mean to the extent of would I play it that I don't think they're going to go bankrupt, but I don't think Limited Brand, who's Victoria's Secret, and one of those candle companies, I don't know which one, one of those candle stores. So would I play them to not go bankrupt? Yeah, sure. More so than Teva. I think I'm less worried. They don't have Teva's debt. Teva's got a lot of debt. So, yeah, I certainly think they'll be around long enough. And then the question would be, do they have good options to sell? That's my next question on it. So let's take a look. Oh, index is popping. See? That was a good long over here. Everything's popping. Look at that. See, the market barely needs a reason to go up. All right, so that's good. What are we looking at? LB? Now, I'm very upset with LB because it's going to be my stock of the year next year. Now I'm not sure what I want to pick. It went up too much. So at 43.50, what can we do with LB? Do they pay a dividend? I think if they pay a dividend, it's a crappy one. But let's take a look. Oh no, they pay a much bigger dividend than I thought. $2.40. Wow, that's weird. That makes it much more complicated to decide what to do. All right. They got 2020. If I buy it for 43, oh my God, look at that. Oh, forget it. That's an easy decision then. You got to be kidding me. You can buy this stock for $43.40, and you can sell the $40 puts for $10.40. So now your net is 30. Wait, calculator. Hello. Calculator. You can do some magical calculations here. So you buy the stock 43.4 minus 10.40 for selling the $40 call. So now your net is 33. Then you say, well, okay, at what point would you definitely buy more of it? And I would definitely buy more of it at 30 for sure. And really, though, 35, since I would definitely buy more for 30, I could push it, and this is a lot of money, so I would push it. I can sell these $35. Oh, actually, it's $32.50. Look at that. If you can get $5.40, that seems reasonable. If you can get $5.40 for the $32.50 put, so what happens is now you're buying it, you're netting 33, but you're not really netting 33 because now you're going to subtract another $6.50. No, I'm sorry, another $5.40. So minus 5.4. So now you're subtracting another $5.40 for collecting that money. So now you have the stock at $27.60. If you get assigned more at $32.50, your average is only going to be $30. So now I'm into $27.60, and I'm going to collect a dividend of $2.40. So my dividend is about 10% of what I'm in for. So in 2 years, I'm going to collect 20% on the dividend, and if I get called away at 40, that's another 50%. So that's 70% upside in 2 years, 35% a year, and all you're doing is promising to buy LB for $30. Okay, the $5 dividend, that's pretty much locked in unless something really bad happens. So the $5 dividend is pretty much locked in. And then if they go over, if they stay, not if they go over 40, they're already over 40. If they stay over 40, you're going to end up making 70% back on your money in 2 years. And frankly, you're not going to want it. You're going to be pissed when it gets taken away from you. That's what happens when you make plays like this. You get a stock that pays you 35% for 2 years. When it gets called away, you want to cry. You're like, now I got to find another one that's that good. But this is a fantastic thing to do with money. Your risk is so low. Your risk is owning the stock at 30. That's a 30% discount to where it is right now. So you got a 1/3 cushion. That's without having to buy a hedge. You're not buying a hedge. You're self-hedging because you're being aggressive even. You're selling the $40 calls and you're selling the $32.50 puts. Your worst case is owning 2x. Whatever you buy, you got to go and double it at 30, and you're going to collect those dividends too. Fantastic trade. And again, like I said, it's the kind of thing where I'm going to be pissed off if I don't get to have 2 times at 30. And we had that discussion today in chat too. We were talking about the stocks will keep going down. I wish this stock would drop 33%. Then I can own a lot of it, and then I can still sell more puts and calls. Any stock that can pay me 70% in 2 years, I want to own as much of it as possible. Now, given that attitude, I might be more aggressive with my put sales, but also you got to take into account that we have a couple like that, like CMG, for example, where we've been aggressive, and we may get assigned the way it's going. Where is CMG? Oh, not this portfolio. So who in this portfolio is like that? Nope. CHK, yes. Now, see, CHK, we sold the $5 put. So you have to think about what your realistic obligations are. So we don't have any real, all right. All right, so CHK is the first one. So we do have a real obligation that we'll have to own 2,000 shares of CHK, but it's only $5, so that's $10,000. So you have to keep in your mind, though, I have a $10,000 obligation there that's in danger of being assigned to me. CLS, we promised, and you look at all your puts. We promised to buy it at 4, it's at 6, that's not a problem. Cisco, we promised to buy it at 32, it's at 34. DBA, we promised to buy it for 20, it's at 19. There's another one you might want to count as an obligation. 15 times 20 is $30,000. Disney, we promised to buy it for 85, it's at 99, so that's not really a problem. FNSR, we promised to buy it for 25, it's at 22, so that one I would count. It's only 5, so 5 times 25 is $12,500. Frontier we already own, so there's not. Oh yeah, we have these puts, so we have $40,000 obligation on these puts, or $20,000 in this portfolio. So there's a $20,000 obligation there. So you want to make sure you count your obligations. I don't want to go through every single one. But you want to look at your obligations now. Before you decide to do another one, you have to be realistic and say, what if they're all assigned to me? How much do I need? How much money do I have? Am I covered? And then, therefore, can I afford to take another chance? Now, it's not likely everything gets assigned to you at once, and it's not likely that none of them are going to recover. But realistically, you have to be prepared for that, and you have to have a plan for what you're going to do in that situation. So, to some extent, if everything gets assigned to you at once, you have to assume the whole market went down. It's not likely just your stocks all got assigned tomorrow. So, if the stock has a terrible crash, then we also know that we have these hedges, and we've got the TZA hedges, which are up here, I think. We've got the TZA hedges, and we have the SQQQ hedges, and we've got the SVXYs. So we have like 100-something thousand worth of hedges. So again, those hedges are exactly for that purpose. Should we get assigned all these short puts, the hedges provide the cash we'll need to pay for it. But you've got to know that about your portfolio. You've got to have the balance. That's key. You've got to have balance in your portfolio. It was SCXY, I was going to you've got to have balance in your portfolio, and you've got to be aware of all the potential assignments you may get. Then you can decide. That then goes back to it. So when I say for that portfolio, like before I said the butterfly portfolio, TIBA would be good for the butterfly because it just has such an incredible return, which you're going to have to, but the math was wrong, so I have to look at it again. But it fits. And whenever you're going to add a position, you have to think, does it fit with the rest of your portfolio? Does it weight you too much one way or the other? Does it mean you are you too much electronics? Are you too much oil? Are you too much this? Too many retail? You've got to think about what your portfolio needs to be stronger before you just go shopping randomly for a stock. What's going to improve your portfolio as a diversified, well-rounded set of stocks that you don't have to worry about in a crash? So like if I go for a speculative stock, I'm going to be leery about going for another one. Like I like adding XRT because it's an index ETF, even though it's not doing so well right now. But it's an index ETF. There's not any specific risk on earnings. That's why we did that before earnings. I like the idea that we would have something that goes into earnings. It's an index ETF that we're just basically saying, well, I think retail will do better than people think. So far, not, but that's what I thought. And here's the VIX. We think at some point there'll be volatility. Fortunately, we sold the puts because the puts are paying for all of our losses. So we took, and again, we were wrong about the 105.80s and things at 106 right now. So we were wrong about the spread, but we were damn right about the puts. We sold these puts against it, and those things are going to expire worthless. So they pay for the entire spread. So this is just a free shot. But as we're sure these are expiring worthless, and in fact they are right now, we can pretty much buy them back, we are going to then adjust these, roll them, and keep this going. Because if I can keep collecting that kind of money for the puts, I want to keep doing it. That's a great way to add money to the portfolio for nothing. So again, in that one, we're protected from 105 to 80. We have $35 worth of protection on these puts. The play was effectively net zero, 40 minus 20 minus 19. So the trade was net zero. And then by making money on the puts, they expire sooner than the spread. So the spread still holds some value, and these expire worthless. So we're ahead of the game right now. But we're so far ahead of the game. What are we? Plus 15, plus 20, minus 7, plus 13. So we're 13,000 ahead of the game. Why wouldn't we keep doing that? It's pretty easy money because, again, the option pricing on the SVXY is so extreme that you just have to say to yourself, well, how can I take advantage of this ridiculous option pricing to make money? And that's what we decided to do. Selling shorter calls many times over rather than once. Well, I mean, I fell in love with LB on that basis, so it's just too good of a play to go for the dividends and stuff. Can you do it the other way? Sure. For example, at 43, we're pretty confident in the pricing, so there's no need to go too low. But let's say you buy the $40 calls. Well, let's see what works out best. If you buy the $40 calls for $10.40, and you sell the $50 calls for $5.20, that's not right. That's a higher price. Let's say you said these 55 calls, $3.50, $5.50, so let's call it $4.50 in the middle. So if you sell the 55 calls for $4.50, and the 40 calls you're paying $10.40, so your net's about $5. So you're in at $45, and it's at $43.50. Now you've got 800 days. I'm sorry, those are the 2020s. You have 800 days to sell, and in the first 40 days, you can sell the $45 puts. Well, earnings are coming up, and I think they'll be good. So I would either do a half sale, or I would sell the 47.50s, give yourself more room. But let's say you sell the 47.50 for $1, because you have 20 of these sales ahead of you. So you're going to collect 20. So your starting basis is you're going to collect $20 against your $5 spread. If you do this every 40 days for 800 days, you're going to collect $20. And I'm talking about selling 10% out of the money call. So is that a good way to play? Of course it's a good way to play. The math is tremendously in your favor. You're going to collect you're going to collect 400% of what you laid out. The math is completely in your favor. You have to have catastrophically bad luck to get burned on this. And the thing is, of course, if it does pop, like for whatever reason, if it jumps 25% on you, and it goes to $50, and you sold the 47.50, so you owe these guys $7.50, but of course your other one is in the money and you're still covered. But even if that happens, you can then add another spread that's higher to cover the what's left on there, and then you can double, you can do all kinds of things. So there's also plenty of ways to adjust it. So I think that's interesting because, like I said, though, you can do that conservative thing we were talking about and get a 70% return, or you can play it this way and you can get a 400% return if you feel like, messing around with it every month. I prefer, because I'm busy, so I prefer to set and forget kind of things. And frankly, you will get burned some months. Some months they'll pop past your short call and you'll take a loss. It's what we do in the butterfly portfolio. Sometimes we win, sometimes we lose. But on the whole, because the odds are so much in our favor, we tend to come out well. In fact, how's that butterfly portfolio doing? Butterfly. So the butterfly portfolio is all those kind of plays. And that one's up 283%, but it's also our oldest portfolio. It's 4 years to get there. But yeah, it's making, 60, 70% a year. And that's exactly how we are playing that. We are doing those. We're buying long positions, we're selling short-term positions, and we just keep selling premium, selling premium, selling premium. That's the whole point of the butterfly portfolio, is to teach people that discipline. There's no dividends. There's none of these are stocks. We don't own any stocks. We're only setting up long spreads and selling short puts and calls against them. And we just relentlessly do it and do it and do it. And some win and some lose, and we don't give a crap. Because again, the math is like what I'm talking about. You're going to sell 400% of what you bought. Sometimes you'll win, sometimes you'll lose, but on the whole, you end up collecting a great deal of the 400%. And that's what I mean. So our winning percentage tends to be in the 60 to 70% range, doing it like that, which is good. FTR, what's your take on earnings and outlook? What about CFC and dividend? Oh, Can you explain the impact of the preferred conversion? Actually, I don't know about the preferred conversion. As far as I understand, is they're buying back the preferred stock, and then they won't have to pay them those crazy dividends anymore. That's my understanding is that they're terminating the preferred stock. And free cash flow. I figured that. They seem to be keeping the dividends intact. They seem to have plenty of cash flow to cover it. I guess the stock sold off so much because they just said that they were going to be having less cash flow next quarter, and that's a trigger that scares the crap out of all the computers that trade it. But as you can see, it bounced back pretty fast too from whatever it was. People are terrified of this stock. It's really crazy. So let's take a look. So my take on earnings and outlook is they're on track. They're doing exactly what they meant to be doing. They're paying down their debt. They're buying back their preferred. They're buying back their expensive debt, and preferred stock is a form of expensive debt, and they're retiring it when they can. And they're continuing to pay the dividend because that's what they see is like the primary reason. Look, these guys are the board of directors, but Frontier has a very small town mentality. They come from rural America, and so when they have a board meeting, it's like, probably it's in the town they started in, and people go to them and say, they're like, oh, my mom depends on that money for her subsidies and everything like that, So they take their dividend really seriously. They don't want to cut it off or screw people over. They know a lot of people are in that stock and counting on them to pay their money, and even though the dividend's gone to be 20%, they're like, well, that's what we promised people we pay. It's not about the 20%; it's about the 240 they promised they would pay out. And they're like, and all the plans that they made and all the maneuvers they made was always have that 240 dividend in a moat where they said, well, this is an obligation we always have and we always pay, and they stuck to it. So, they did reduce it one time, I think, but they basically stuck to their plan. They're keeping it, and they're doing everything that I would do if I was running the company. I've got no complaints about the way they're handling things. And so to me, that's a bot, because I should run these kind of companies. I used to be a consultant for these kind of guys, and I did M&A consulting, and I did also efficiency consulting. And, I'm used to looking at this kind of stuff. But the problem is this is a long-range thing. It's like what people don't get about a company like Frontier is it's a cyclical company. They're in a building cycle. They just bought 3 states. They doubled the size of their company because they bought 3 of Verizon's states. They bought Texas, Florida, and California. Unfortunately, a hurricane hit Florida and a hurricane hit Texas in the same quarter. And that knocked down a lot of their lines and caused them to spend a lot of money on repairs, and it slowed down their bills and so on and so forth. And that's why next quarter they have $100 million less cash flow than they planned on. It's not their fault. There's nothing wrong with the company. They're not doing anything wrong. They're proceeding with their plan. They knew they'd have a lot of churn because that's exactly what happens when a new company takes over. People tend to start looking like, if even AT&T had this when they changed their name to whatever, and then they changed it back, Singular or something, or whatever it was. Anyway, AT&T at some point changed their name. When they changed their name, then Verizon and Sprint and everybody else, and MCI, remember MCI, they jump in and pounce, and they start flooding the people with their advertising because and give them all kinds of crazy offers. So they try to steal the customers while they're a little bit vulnerable. Because while you feel, even though it's still AT&T, you might feel that the company's changed, and any kind of complaints or issues you have, you may say, well, maybe it's time to take a look at somebody else. That's what happened to Frontier when they took over Verizon. But they knew this would happen. They have in their conference call, they have things called churns and so on and so forth. They track it. They know exactly what was going to happen. They planned on it, and they had a schedule for that too. And they've reduced the churn rate exactly where they thought they would reduce the churn rate to. So everything they're doing is in line with their 20-year plan. The problem is investors don't work on a 20-year plan. Investors work on a two-quarter plan at most. And that's why you get these ridiculously undervalued stocks, especially in the cyclical things. Chicago Bridge and Iron is another one. GE is another one. I mean, people don't understand a company that like turns themselves around or builds for the future. Chicago Bridge and Iron is fantastic at this time. Back down at 14. I mean, we were talking about them here, and we already bought the stock, but anything under 15 is a great price for these guys. And it's another one. It's a cyclical play that is in a down cycle, but that's fine. When else are you going to buy them? You know, home builders. Have some Navy there. Navy our favorite on the home building side. Still pretty cheap. I mean, it's not bad. I mean, we were pretty much buying in the ones, but Canadian's still pretty good. There's a lot of companies that when they're down in the cycle, nobody wants to touch them. But why would you not? If you have to not look at the chart. You have to look at the company. Like IMAX. Was it IMAX? IMAX. Now, they want the one, though. I talked about this. CHART. SVU, right. Here's my comment on SVU. See, SVU, here's what I said. Let's roll our 13 calls so we rolled and doubled down to the 10 calls. So when they were here, this is when I come, unfortunately, shorts redraw themselves every day. When they were here, literally the candle was here on the day that I did it. And I said, I know this is an ugly chart. And I said, let's roll out 13 calls. So we were down at 14 something. So I said, let's roll the 13 calls to 15 of the 10 calls. We're going to buy back the short calls to clear the space, and we're going to roll our short puts to 15. We also rolled and doubled down our short puts. And the chart, I didn't make that move here or here. I made the move when it was horrifying. And I said, I know this is an ugly chart, but it's a small position, and we'd be happy to double down again. Again, you always plan for the worst thing happening after you do whatever you do. Just announced earnings this morning, and they were 46 for the quarter. They just announced earnings, and they sold off like that. And they just announced earnings with 46 for the quarter, so $2 a share 4 years, a PE of 7.5 versus 19.4 is the PE of Kroger, 10.6 is the SFM. Who's SFM? Cisco is that? Anyway, whoever that is. So 10.6 for SFM. And if you want to compare them to the wholesalers, the UNFI is 14.9, and that's Cisco. And this Cisco is 19.8. Who's SFM? Scrap. So in other words, their PE is half of what their competitors is. And just like today, on whatever it was we were looking at with the earnings, just like they with STR, it's like they announced earnings, they crapped out, people freaked out for whatever stupid reason, and I'm sitting there saying, I don't know, they're earning $2 a share. And I think part of the difference is look, it's from experience. I don't have a crisis of confidence just because a stock moves against me. If a stock moves against me, I'll look at the numbers again, I'll check the figures again, and I'll try to find out if there's some logical reason for it, like FTR today. And if I don't see one, like FTR today, and I look at the numbers and I say, these are fine, then I'm going to buy more. I'm not going to let the crowd dictate when I buy and sell something. In fact, if the crowd is panicking and selling exactly like Warren Buffett advises you to do, you've got to sit there and say, well, what is this thing they're so freaked out about? Because this might be a great opportunity to buy now when they're freaking out. And there are millions and millions of people who panic. And there's only a couple of guys like Warren Buffett who have the balls to not the balls. I don't want to say it's being brave, because I'm not being brave. I've got conviction. I've got a clarity of vision, but it's also based on experience. I've been doing this, even though I'm only 55, not even 55, I'll be 55 in March. I'm only 55, but I've been doing this since I was a kid. And I learned from my grandfather, who would be 120 now. No, 114 now. I learned from my grandfather, who'd been doing it since the turn of the century. And he used to lecture me just like I'm lecturing you and say the same kind of thing. And he would say, there's nothing to worry about. If you like the company and you know it's solid and it's going down in price, then you've got to say, this is where I'm going to be a buyer. And if it goes lower than that, you have to say to yourself, I bought it, and now I'm going to wait until it comes back, until other people realize that they are panicking over nothing. And that was drilled into my head when I was a little kid. Because my grandfather was the ultimate patient investor. And he had lived through the Depression. And that's where he got it. I don't forget, the Depression wasn't like the crash in 2008. They didn't fix it 2 years later. The world was a catastrophe for like a decade. More like 15 years. Like it was until we got into World War II. Like like more than 10 years. It was a catastrophe. Like 25% unemployment for 10 years kind of catastrophe. That's what he lived through. And he he had that vision of how the world goes and how weird things are, and he went through that, and then the post World War II boom, and then the financial crisis bust, and so on and so forth. He was going through all those things, and he thought he died right about when I get married, 1998. So that's the year he died. So he got married. So he died in 1998, and he was so amused by the internet and what a fad it was and computers and things like that. He thought the whole thing was so funny because it just reminded him of the electronics boom when he was a kid. You know how everybody got into gadgets and things like that, and everybody wanted a TV and a car and a radio, so on and so forth. And to him, it was just an echo of the same thing happening all over again. But we used to have long conversations about that, about how you never know who's going to win. One thing he told me is really valuable. You never know who's going to win. I said this about 3D printing, because we talked about back in 3D printer companies. So you can't, just because these guys are first to market doesn't mean they'll win. And I got that from my grandfather. Because he used to tell me, he said, do you know how many radio companies there used to be and how many TV companies there used to be and how these guys would show this groundbreaking invention and so on and so forth? And he says, and 2 years later, you never heard from it. He goes, so you can't just invent something and you can't just be first. You have to be able to run a company, which is why we're shorting Tesla, by the way. Because there's a difference between being first and being good. And these guys, from all indications, don't seem to know how to run a company. So we're very weary on that. All right. So anyway, all right. Good time to wrap this up. I'm going to just take a quick look at the market and see where things are. I will be looking over stuff, though, because it's like some of these things like TV is a great thing to get out of. I was hoping for more of a bounce here. It's like I don't like being out of this, but I didn't want to risk it going up higher. I'd like to get back into that one. Natural gas, so as a play, everything's run up on us already. Oh, wow, look at, this is coffee. So coffee's moving up. That's one I said I liked at 125, and that's already popping. Natural gas here is still a great price down here in the 290s. It's 292 at the moment, so I still like that one. Other than that, no. I wouldn't touch anything. I want to see, we let the people digest the Fed and see what they're going to do. I mean, you can see already the S&P and the Dow are moving back up. I don't think it's really changed my attitude about anything. I'm more concerned now that the Fed's gone. Now it depends on who Trump appoints to the Fed for the next chairman. And then, of course, you got to worry about whether or not Trump will still be president in a few months. So we watch the indictments and so on and so forth that's going on. Friday, we get the non-farm payroll report, and we'll see how that goes. And then we get, we'll just keep analyzing earnings and see how the earnings are going. So that's it. Not that complicated. These bounces are amazing. But as it seems, the big overriding thing though, I've lost my flavor from being short the market. I mean, when it spiked like today when we shorted the S&P up here, it was because it was just a silly spike and it was shortable for a short-term play. But as a rule, I'm not generally short on the indexes, and I certainly wouldn't leave index short overnight because it's just too crazy. It's like things are just going up and up every day. It's like 1999. Every day things go up just because that's what the market does every day. It goes up. Until that really reverses and you get a serious trend that shows a reversal, like here you go. Remember I said 91 was a strong bounce, 97. I mean that's a weak bounce. 91 was a weak bounce. 97 is a strong bounce. So what we're looking for is if 91 holds into the close, it'll probably go for 97 tomorrow. If we get to 97 now, before the close, and we hold it, then we're probably going to fully recover. And here you already have a strong bounce being tested right there. And you can do the math. It's 23,450, call that. And then we go down to 350, or really 325. So it's a 125-point drop. And that means your bounce is going to be 25 points. So 50 is a weak bounce, 75 is a strong bounce, and we're already over that. So this guy's already on the road to recovery. The S&P is probably just a bit over the strong bounce line. So that means we definitely expect them to go up to 97 now. But anyway, so the point being, I don't have the confidence there. I like longs better than shorts, so I look for longs. And coffee long and natural gas long are two that haven't moved yet. If the market keeps going up, there's no reason they won't follow up higher. So futures-wise, those are the plays, and otherwise we'll see how the earnings go. Oh, and Apple earnings is tomorrow night too. Oh, that's going to be huge. So we'll see if Apple can sustain, can get over the 170 mark. That'll be interesting. All right, so thank you very much for coming, everybody, and we'll do it again next week. All right, take care.